Hello, everyone, and welcome to our second session for today. My name is Ricky Keller. I'm an MBA student here at Quinnipiac University and Game Forum's Outreach Chairman. This keynote panel presented by the World Gold Council will cover ESG and the importance of governance and impact investing. The moderator for this session is Amy Wilson, who is a Director of ESG Investment and Portfolio Management for Glenmede Investment Management. Wilson is a chartered financial analyst, charter holder, and guides the firm's approach to environmental, social, and governance investing. She leads the investing through the integration ESG criteria across fundamental equity and fixed market income. Wilson earned her MBA with honors from the Wharton School of Business at the University of Pennsylvania. She graduated from Pennsylvania State University's Schmeal College of Business with a Bachelor of Science in Finance. Please welcome Amy Wilson. Our first panelist is Daniel Tremblay, the Senior Vice President and Director of Fixed Incomes in the Fixed Income Division at Fidelity Management and Research Company. Daniel Tremblay oversees the liability-driven investment solutions team and is responsible for developing customer holding strategies for LDI clients, providing de-risking solutions, and representing the investment process in the marketplace. Tremblay earned his Master's of Arts degree in Economics for Northeastern University and is a chartered financial analyst charter holder. Please welcome Daniel Tremblay. Our second panelist is Jessica Long, the Head of Sustainability for Americas at Nuveen. Long is actively engaged in the green building strategy for Nuveen's asset, corporate sustainability leadership, and ESG reporting. Before her time at Nuveen, she worked with JBG Smith for 12 years and 2 of those years as a director of sustainability. Long earned her Bachelor of Arts in Business Administration, Communication, and Economics from McDaniel College. Please welcome Jessica Long. Our third and finalist is Hannah Bransetter, the ESG Program Director at the World Gold Council. She oversees key initiatives, including responsible sourcing and gold's role within society. Working closely with World Gold Council's 33 member companies, she develops leadership focused on the gold mining industry's socio-economic contributions to the UN Sustainable Development Goals and host nations across the globe. Prior to joining the World Gold Council, Bransetter held positions of ascending responsibility in agencies covering global strategic communications, crisis management, and financial public relations for the oil and gas, mining, industrials, and petrochemical industries. Please welcome our panelists and moderator for this session. Thank you all for being here.
All right, well, thank you for that introduction, Ricky. So I know we're all excited to be here today, and I know I'm particularly excited to be here to facilitate our discussion on the importance of governance and ESG investing, and really look forward to partnering with our panelists to help answer some of the questions that we've received from students joining us today. I think one of the largest challenges for the environmental, social, and governance, or ESG investing space today is the jargon. I think we can all agree on that. You know, there are endless acronyms, various types of ESG investing, no standardization of regulation yet to date in the US. So not to mention that the space is new and constantly evolving. But given the fact that sustainable investments now comprise roughly 1/3 of global assets under management, and this is according to the Global Sustainable Investment Alliance, it's really an important area for investors to understand. So to kick us off then, I wanted to take a step back and define what we're talking about in the context of everyone's roles. So I'll start with Jessica, but would love if you could give us some context and can you define what governance and impact investing in the context of your role and your industry means?
Yeah, thank you. Happy to be here today. So to start things out, so I'm the head of sustainability for Nuveen Real Estate, which is our real estate asset management arm. So the team that I work closely with manage direct investments in real estate. So we go out and we buy buildings and we own and operate those buildings. We do partnerships with JV partners, so other real estate companies where we're providing capital and they may be running the day-to-day real estate investment asset. And then also the team that I work with does debt investments, so commercial mortgages. So, mortgages on large commercial buildings like office buildings and multifamily buildings and in industrial warehouses. And so that is, the kind of scope of what I do. So working with a lot of different teams that are making investment decisions about what type of real estate, what location. We are going to invest in, and then what we do during the period where we own that building. If we own that building for 10 years, what type of improvements are we doing? How are we engaging with the occupants in the building and the surrounding community where that building is located? So that's kind of the overview of kind of what it is that I do. And when I think about real estate and governance specifically, real estate is really unique in the sense of we are not just investing in a company that has its own management structure and governance. We are actually, like I said, buying that building and then managing the building. And so every building is almost like its own little business. They're actually all set up as like individual LLCs. So, 1, 2, 3, 4 Main Street LLC is its own little business. And so there's a lot of governance required to make sure that that building is being managed sustainably, that we are really kind of have all of the pieces in place to be able to protect the value of that investment, because we are responsible for everything that happens during our time of ownership. And so, when it comes to ESG, really monitoring, managing the impact that on the environment and the community that building has. And then, like I said, kind of more broadly, how our own company is set up, rather than if you're an investor investing in another company, you're looking at, from a governance perspective, how that company's board is set up. What's the diversity of their company versus for real estate? It's very much kind of more inward looking at our own organization and how we are running our real estate investment teams. And then when it comes to impact investing, I think there's kind of two sides of it. Again, as those kind of more active owners of our investments, we actively measure the impact of our investments on the environmental side. So because we have that direct control, we are able to measure the energy performance of the building and our carbon emissions. And so we're able to report on our environmental impact and strategy. But when it comes to actually what the market is looking at as impact investing, where you're actually seeking an impact through your investment activities, I would say that affordable housing is really the primary focus in the real estate industry. One of those things where we recognize that our industry can have an impact, and we actually go out and seek investments that have a positive impact. And so that's really kind of the crux of how we look at it within real estate.
Yeah, no, that's really interesting. And I think it'll be interesting to hear from other folks as well, because we all come from such different backgrounds. So it can really mean a lot of different things to different people, especially within the context of all of our roles. So Daniel, I'm curious what you think as well. So how do you think about and define governance and impact investing in the context of your role?
Sure, thank you. So as mentioned, I work at Fidelity Investments. I'm an ESG strategist, and I spend 100% of my time thinking about ESG, both helping Fidelity build out its infrastructure and then facing off with institutional clients like sovereign wealth funds, pension plans, and 401k investors. And to us, when we think about ESG, we think about the alignment of ESG materiality factors with both financial performance and investor values. And if you think about managing to that triple bottom line of people, planet, and profits, and I think what we're all finding is that you can have it all. You can have both. And at first there was concern that if you lean too far in on impact on some of these sustainability variables, are you giving up performance or managing risk? And there's a huge sensitivity around that. But I think what we're finding is we're building out our investment process, and we're facing off with these companies to understand how they're handling these sustainable issues. What you're finding is that the companies that have stronger sustainable traits when it comes to governance, environmental and social factors, over the long term, are going to be the better run companies, whether we see a lower cost of capital. We think about industries that are evolving dramatically because of changes in investor preferences, or I should say customer preferences, whether it's clean energy, whether it's in EV cars in the auto industry. And so we argue, how many tailpipes a company sells today in the auto industry is irrelevant relative to the race towards EV and the capital investment in the EV battery storage and everything driving that, as we think about the risk of stranded assets or uncompetitive business model. So I guess to summarize for us as investors, it's making sure that we're asking the right questions. We're thinking how we value those E, S, and G factors, as we call them, and then thinking about how that drives financial performance of companies. And then along the lines, can it still meet the consumer and investor preferences around outcomes and social benefit and so on? So it's really trying to maximize both. But what I think I want to be clear is a strong view that these are material factors driving financial performance.
Okay, thank you. And then I think we have Hannah as well, who will have very different perspective on the commodity side of things. So how would you respond to that question?
Well, I think, from a governance perspective, obviously from a mining perspective, governance is really important. And we at the World Gold Council, we have something called the Responsible Gold Mining Principles, which are basically 51 individual principles that talk to the E, S, and G, and all of our members, but also other gold mining companies are implementing these principles, and they have to be by third party externally assured and publicly disclosed. And when we put them together, we actually put the G first, the governance first, because if you can't get your governance right, how are you going to get the E and the S right? So I think that's on governance. But if I think about impact investing, we actually hosted a webinar with EY a couple of years ago, and the title of the webinar was, "Should gold be considered an impact investment?" And it raised a few eyebrows, like, how dare you say that? But I think what's often not understood is the socioeconomic impact that gold miners are having. And so we've done a lot of work on the SDGs, how is the gold industry contributing to the UN Sustainable Development Goals? And we found that we actually contribute to 16 out of the 17 goals. That the only one we don't really have make a significant contribution to is 14, which is life below water, and it's just not applicable to us. But then we spoke to investors, and we told all the great stories around how the industry is making contribution, to especially on healthcare, for instance, working to reduce malaria rates or improving access to schools and so on and so forth. And they said, well, that's great, but how are you going to quantify this? Well, what are the numbers looking like? And so last year we released a report, and we looked at that specifically. And what we found is we basically asked our members, can you provide us with data in 4 categories: payments to suppliers, payments to governments, payments to communities, and payments to employees, and let us know how much of that is spent in country versus out of country, and that country by country basis. And so what we found was that out of the 60 billion of revenues of gold production from our members, 63% of that stayed within countries and contributed to the GDP of the host nations. And that's a huge amount. And so when we look at that, and it's not just financial, but that's pretty much equivalent to overseas development assistance. So it's a huge way how these companies, especially in developing countries, like, if I think about Burkina Faso or Senegal, that economic contribution that they're having. And it's not just financial, it's also, employment. People always think, well, there's the gold mining company comes in, brings a lot of expats in, but actually 95% of employees are locals. So they then support, one job supports another 6 jobs, and so on and so forth. So it's that social impact that the industry is creating that I think often isn't that well understood by investors.
Yeah, no, and I think it's so fascinating because you have this one word, governance. And again, here we are all using it in a different facet and within the context of our roles, and really applying it in different ways. And so I would say for me, my role is probably most similar to Daniel. So when we're thinking about governance, again, it's that one pillar of ESG. It's thinking about materiality, how a company is managing its operations, are incentives for management and employees aligned? How are we thinking about the policies, practices that management has in place to avoid conflicts of interest, to make sure they're acting in an ethical manner and to serve their stakeholders? So whereas, on my side, we're looking at the companies that we're investing in. It sounds like for Jessica and Hannah, it's a little bit of a different perspective, but again, very, very interesting context, I think, to kick us off. And so now that we know how we're all defining ESG and governance in the context of our roles, I'd be curious to hear from folks about what are some different trends that we think will drive the ESG agenda in 2022 in each of our respective industries. And actually, Hannah, I'll turn it back over to you to kick us off.
Yeah, sure. I would think from our perspective that there's probably going to be four trends that we might see. I think the first one is an increased focus on the S in ESG. I think we've seen a lot of focus on the E, but I think COVID has also very much brought that to the forefront. You know, what is the S? What are the things that we need to tackle from a social perspective? I think the second one is a continued focus on climate change, but I think it's shifting a little bit. I think we've seen a lot, especially leading up to COP26 in Glasgow, we've seen a lot around net zero commitments by 2050. And that's great. But I think we're going to move away from that a little bit. And we look at from long-term goals to short-term actions. What are we actually doing by 2030, for instance? What are companies doing? How are they reducing their emissions? What that's going to look like? And I think also different aspects of climate are going to become more important, like water, for instance, or biodiversity, and how companies are looking at that. I think the third one for me would be a continued focus on diversity, equity, and inclusion. From a mining perspective, for instance, the global mining industry has between 5 and 10% of women in their workforce. I think for our members, it's about 17, but that's still, that's a little bit better, but it's still very low. And whilst we've seen a lot of focus on boards and gender parity at the board level, I think there will be continued focus on, what are companies doing to attract different talent, to attract a new workforce that is diverse, that has diversity of thought. And I think for me, the fourth one would be around increased focus on convergence of standards. I think it was yesterday or the day before that GRI, the Global Reporting Initiative, and the IFRS, all these acronyms, I keep on getting confused, but the International Financial Reporting Standard agreed that they're aligning their capital market and multi-stakeholder standards. I think we're going to see more of that. Again, from a mining perspective, there's so many standards out there. We have got our responsible gold mining standards, the ICMM, the International Council of Mining and Metals, they have theirs. Then if you have more localized in Canada, you've got the Mining Association of Canada, and then you've got GRI, you've got SASB. There's such a reporting fatigue. And I think, we definitely hear that from our members. Convergence of ESG standards are going to be very important moving forward. So that would be my four trends.
Yeah, I think that's, in some sense, there's some overlap in terms of how we think about things in the financial services industry in terms of transparency and disclosure. So not only, I think, is there that growing interest in environmental data and disclosure, we've recently seen the SEC come out with recent guidance on climate disclosures, but also, as you mentioned, that convergence among the different organizations like SASB, that Sustainability Accounting Standards Board, into the ISSB, or that International Sustainability Standards Board. So there are a lot of moving parts and a lot of things to keep track of, especially too as it relates to DEI, transparency, thinking about how we're reporting out and disclosing on these different characteristics like gender, racial, ethnic diversity. I imagine that Daniel is probably seeing some similar things in his role. So I'll see what he thinks in terms of what trends do you think will be most important to our industry.
Yeah, sure. And so, from the bottom up, there's an endless number of projects we're working on around client education, better investment decision-making, impact reporting, data clarity across asset classes, how ESG may fit a mortgage security differently than a corporate bond or a sovereign. So those are all the bottom up. But when I think of the most significant financial services driver for the next year or two from the top down, I think it's clarity from the regulators. You mentioned it in your opening statements, Amy, and I think right now, the regulators are applying extra scrutiny, some partially deserved, to the industry when it comes to ESG. And I think some of the factors driving that are a lack of common taxonomy, incomplete or inconsistent data sources, lots of new product coming to market, lots of dollars flowing behind that product, and a few bad actors. And so I think when you combine all of those, regulators are going to say we need to slow things down, but we know the market is moving quickly. So I think the good news is they're moving in the right direction, whether it's the DOL and their association with retirement plans, providing clarity for 401k investors and others to implement ESG in their plans. And so the DOL came out with a comment letter in October that did explicitly support ESG as a material risk factor in return and analysis. And again, notice that distinction on financial performance, not just impact. And so that hopefully will be finalized this summer, and expectations are to provide that clarity that we need or that support. And then we had the SEC, as you mentioned, just in the last week, helping with climate disclosure. So I think the good news is they're pushing in the right direction. And I think their ultimate goal is for investors to be able to make informed decisions. Today, because of all the great work out of FASB, generally speaking, if you pick up a 10K and you look at different financial statement analysis, you generally know the methodology behind that. Today, when we look at someone's carbon footprint, we don't know if it's science-based, how they're measuring it, what they're comparing it to. The wild card is something called Scope 3, which is the hardest to measure, but in honesty has the most impact on us hitting our global temperature goals. It's not so much the Scope 1 direct carbon footprint on a bank, it's how they're lending money or how other people are seeing carbon move downstream through the value chain. So without getting detailed about that one nugget, the key takeaway is we need good data to make informed decisions, whether we're astute investors or whether ultimately clients saying, look, I may not understand what an MSCI ESG rating is, but I know that I would like to align some of my personal values with investing. One, am I clear what I'm getting when I do that? And two, is someone made clear to me if there's any potential investment trade-offs, not right or wrong, but at least I'm aware of that when I make my ultimate decision. So all of that guidance has to come from the regulators that allows us to be a little more free in the way we're able to communicate it and have better clay to communicate those points.
Yeah, no, I think that's really fascinating. I'm curious if Jessica, does that regulatory piece, does that extend to you? You know, what are you seeing in the real estate space that's driving the ESG agenda?
Yeah, I'll say I love being on panels with other ESG people, and I don't think anybody could have said it any better than Daniel just explained it. So I think that was really great, and I couldn't agree more with everything he said. So I won't repeat all of that. I'll just kind of elaborate a little bit more. I do think transparency, credibility, and alignment, standardization of reporting is going to be key. The thing that's come up a couple times that I maybe want to center in a little bit on is ultimately this is about our jobs in managing our clients' assets. And so, you know, large pension funds and institutional investors as well as individuals are kind of handing over money to us as fiduciaries to invest that money with targets to seek returns. But the conversation has changed to now, at minimum, they want to know that we have managed ESG related risks to achieving those returns. If there's a chance that we're going to invest their money and they're not going to meet the returns, or even worse, lose that money because of some sort of environmental, social issue that we haven't taken into account, that is now seen as a breach of our fiduciary duty. And that's what, going back to the way that Daniel was saying it, that's what it means for ESG issues to be considered material. And so I think that is a real game changer, because up until now, it's been very much like, oh, if you're doing this, you can feel really good about it, and you can talk about all the great things you're doing and, you know, earn goodwill in the market. And now there's this understanding that, you know, there needs to be some consistency in the way we talk about environmental and social issues. We need to understand if it's really being managed appropriately and what the impact of those activities of a business or an investor really mean in the real world. And so I really say that ESG starts with managing risk. And I think within real estate, obviously, you know, climate risk and the transition to a low carbon economy is going to impact all sectors. But with real estate, the way we look at climate change is really an opportunity and a risk. The building sector produces almost 40% of global emissions, and it's connected to all businesses, right? If a corporate entity is now reporting their emissions and they are a tenant in one of the buildings that we own, our scope 3 emissions are their scope 1 and 2 emissions. So that scoping of emissions starts to come into the discussion. And so real estate is really connected to everything we do as a society, where we live, where we work, where we play. And so we really want to make sure that we are on top of that, again, as an opportunity to get out ahead and have green buildings in our portfolio. And also then on the managing risk side, the conversation is moving forward very quickly. Local jurisdictions have set green codes and performance standards requiring buildings to meet certain levels of performance from an energy perspective, from a carbon perspective. And so that now really forces the conversation to, okay, well, it's not just about feeling good that you're doing this and you have green buildings in your portfolio. You're now essentially required to green your building through the legislation that is in place in the jurisdictions where your building is located. And unlike some other industries where you can just maybe move your business to another location, a building is kind of set in that location. And the political environment is a big driver of moving things forward and setting those expectations for building owners in a city or a community.
And I think you bring up a really good point, connecting everything together and tying in how that regulation and how that standard setting then enables that reporting. And then what are the knock-on implications as we're thinking about managing a business and getting back to that governance question, right? So I think I'm going to skip over one of the questions we had planned to talk about, because I think we really answered it in terms of one of the most important issues, especially for financial services, but extending, I think, across all of our industries. But curious though, has 2021 and things that have occurred over the past couple of years, are we starting to see that pressure build up to governments and corporate leaders to enhance their ESG skills, and how do we see them in trying to enhance their skills? So we're starting to see this regulation come into play, but what other things are we seeing that how governments and corporations are responding? And Jessica, I'll turn back to you really quickly for that one, and then we can move on. But I think this is an interesting point to discuss.
Okay, yeah. I mean, I'll just quickly say, yeah, everything has changed in the past couple of years. Again, there's been some organizations that have been very forward thinking on this for many years. And companies that have been kind of doing, what they thought was good for many years as well. But I think now with this regulation piece of it, with this requirement for consistent disclosure, there's really a need for having an ESG person, somebody trained in this language that we're speaking right now, and being able to advise the leadership, complete the activities that need to happen to collect all of this data, analyze, report. And that's just doing the reporting. If you're actually going to use that information to inform how you manage your product or your business or your investments, that's a lot of work as well, training everybody. So where it used to be, okay, maybe you could have one person that's kind of focused on this. Now it really is more broadly accepted that it's everyone's responsibility to consider ESG as part of their day-to-day decision-making, not just maybe, one person over here measuring impact, or, somebody in a CSR role, corporate social responsibility. But now it really is becoming core business to have ESG dedicated roles and baked into everybody's responsibilities.
Yeah, I think I couldn't agree more. And part of the way I think about it too is sort of this shift to sort of stakeholder management and thinking about things more broadly, because it is touching into all of these different areas of business. So I think that's really interesting. Daniel, any other
that point?
Yeah, I was gonna say, any other interesting perspective there from you as well?
Terrific. So, as I think about it and the way we're facing off with companies in our engagement dialogue when they visit us at Fidelity, and you think back to 5 years ago where they may have not brought a sustainability expert, and it may or may not have come up in the conversation to, all right, don't forget to ask them about their carbon footprint before the meeting's over, to now they're walking in not only with the sustainability team, but also the traditional C-suite is ingrained in talking about it. And the best way I characterize it is it's no longer a tangential conversation. It's part of the primary conversation. How are we managing our carbon footprint? What are our supply chain transparency? How are we thinking about board diversity? And so that's from the investor lens, where again, these are mainstream issues that they're thinking about. Well, why is it that they care, right? If you think about it, their main objective is to maximize shareholder value. So we can have all the passion in our heart, but if it doesn't move the bottom line, they shouldn't be and won't be focusing on it. And so what we're seeing in the marketplace, and I think everyone on this call, even in the audience, knows that customer values are being seen at the C-suite now. And when I think of more recently, not just what we've seen in our own business trends, but look at how quickly companies responded to stepping away from Russia so quickly, and the feedback loop if you did not, and how that's impacting you, even if it's just an insignificant portion of your overall revenues. The branding impact of still doing business in Russia in the current environment is not great, right? And I certainly don't mean to turn this political in any way at all, but we're just seeing investors and customers vote with their feet, and companies are now having to respond to it. So the last point I'll make is, we as investors used to say, well, what's the next tobacco, or what's the next, bad actor? Well, now we've seen, as everyone has stepped away, not feeling comfortable where there may be a dictatorship, what is the next risk we want to uncover in our ESG analysis that maybe wasn't at the forefront today, but then it becomes a big deal because you've got the obvious bad actors, so to speak, from an ESG perspective. But the question is, how can this uncover the next one? And I think we've seen something like Russia be a very quick response from the marketplace on how they're responding to what they think are customer preferences.
Yeah, I absolutely agree. I mean, I think we're definitely seeing just this more proactive approach to managing risk. And I think at the same time, though, yes, we're looking at managing risk, but I think there's also an aspect from an investment perspective of thinking about managing for opportunities as well. So thinking about clean technology going forward, and somebody's cost is somebody else's revenue, right? So thinking about what are again those implications moving forward. Yes. I want to hit us on a really not a sensitive topic, but I think something we've all heard about as well, which is greenwashing, right? So this process of where you're conveying potentially a false impression or misleading information about how your products might be entwined with being more environmentally sound. So I think there are certainly different ways to respond to this, but what do you believe for your industry is the best way to combat greenwashing? And should the standards for company disclosures be improved to then truly hold folks accountable and honest to their shareholders? And I think we've answered that second question a little bit. So I guess maybe just touch on the first piece of that. So how can we combat greenwashing? And I'll turn it over to Jessica.
Okay. I think that everything we've been talking about is key to combating greenwashing. So it's about disclosures, right? There's the regulators, as much as we hate regulation, right? They come in and they say, you can't put a label on this product if it's not what the product actually represents. And so now we're seeing people recognize that you can't come in and claim that a product is environmentally friendly if it's actually doing harm to the environment, or that you can't back up how you came to make that statement. And so all of this talk about disclosures and standardization of data is really about kind of giving investors confidence in those statements. And so I think we're in a place where there's still a lot of qualitative aspects of ESG disclosures. What's your strategy? How are you managing this risk is very kind of descriptive. But then bringing in this data and really formalizing how the data is going to back up that statement. And I thought Hannah's example of kind of how they broke down the spend was a great example of that. For real estate, we have certifications, right? And so I can say, this is a green building, but there's actually the U.S. Green Building Council or the EPA Energy Star program, which will certify the building. And there is a checklist of things that is third-party verified that will come in and say, oh, this building is, you can put a title of green on this building because it passes all those tests. And I think those are the types of things that you're going to see kind of become more prominent to kind of help with the greenwashing.
Yeah, no, that's really interesting. I think too, from an asset manager perspective, when you're thinking about combating that perception of greenwashing, it's really about process and documentation and making sure you're really clearly demonstrating how ESG is affecting your investment decision making. So directly linking how those ESG considerations affect revenues or margins or valuations of the companies that you're looking at and investing in. So I think, for example, you could think of a company where their cost of employees is maybe up to like 30% of their expenses, fairly common. So for a technologically complex company where they're doing a lot of software development, workforce talent is incredibly important. And so thinking about that ability to retain and maintain that talent can really directly impact the revenues and future growth opportunities for that company. So really spelling out how you're thinking through some of these ESG criteria, whether it's in the environmental, social, or governance pillar, and then how that links back to, again, your financials, and getting back to Daniel's point about financial materiality, really being able to demonstrate how and if it's impacting your investment decision. And I think we also all talked about this earlier. It's that corporate and leadership commitment. So if you notice that ESG is central to marketing, but maybe investment leadership or other pieces of the business haven't supported that, I would imagine that might be a red flag, right? So thinking through, how can you really communicate, demonstrate that ESG is a core piece of the process and that you're being authentic in how you're thinking about things.
Maybe just adding to that one sentence, when advisors are doing their due diligence, like your firm on a Fidelity, they often tell us it's not what your direct ESG team tells me. I expect them to be passionate about ESG. It's when I talk to a traditional portfolio manager about lots of different things, and do they actually bring up ESG proactively when it wasn't the main topic? And I think it's along your lines of, of course, a company's sustainability SWAT team is going to be passionate, but is the finance manager, is the CFO talking about it the same passion and same intensity as the so-called dedicated sustainable experts?
I think that's a really great way to describe it. Moving beyond that sustainability SWAT team, right? Is it ingrained in the culture of the company?
Right.
So for the sake of time, I might skip over, because I would love to get Hannah's perspective too, from a different asset class perspective. How do you see that ESG investing application in commodities and gold? If you could elaborate on that a little bit more, because I think it's just such an interesting and different viewpoint.
I think it's really interesting because I think it's now very widely understood that we will need a lot of metals to deliver the infrastructure that we need for a net zero economy. And I think mining companies, really have to adapt themselves and they have to deliver this material, but they have to also minimize the negative impacts. And I think we've heard that from all about us about minimizing the negative impacts. And I think investors, but also the general public, are really going to judge these mining companies, because on the one hand, we will need the mine materials, but on the other hand, how are they going to produce them, right? But I think gold has a very interesting story, and I've heard Scope 3 a few times mentioned here, and gold is quite unique because for us, from an asset perspective, we think about gold as an asset. Scope 3 is really not important to us. It's 1%. So 99% of emissions are Scope 1 and 2, and they're very much at the mine site level. And we've done a lot of research on that for over the last 4 years, and one of my colleagues leads on this. But we always work with independent partners because, again, back to your greenwashing point, I think it's important that you have independent research partners helping you analyze the data that you can gather. And we look at it from both perspectives, the mining side and from gold as an asset perspective. And from a mining perspective, we looked at 150 mine sites, member companies, non-member companies, and we looked at what can we do by 2030, what's realistic, and what can be achieved by 2050. And we believe that there's a very credible pathway that the gold mining sector can decarbonize by 2050. So what would that mean for gold as an asset, which was then the second question? Obviously, gold would be a net zero asset. So last year we worked with a partner, research partner called Argentum, and they work with the likes of the ECBs, the European central banks, really trying to figure out emissions profiles. And we work with them, and we looked specifically at a portfolio of equities and corporate bonds. So we looked at 70% equities, 30% corporate bonds, and then we added gold to it. So we had 65% equities, 25% corporate bonds, and then 10% of gold. And what does that do to your portfolio? And just to mention, like we looked at the worst case scenario. We looked at looking at a bullion buy, thinking that 70% of that gold would be newly mined gold. That's very likely not to be the case, because gold is obviously the ultimate recyclable asset. But even with that quote unquote worst case scenario, when we looked at that portfolio where we added 10% of gold, we saw that that portfolio, the emissions intensity of that portfolio was 7% lower. So I think it will be really interesting how investors are going to look at gold because of the way they look at gold as a risk mitigating asset. And is it going to be a climate risk mitigating asset as well? So, very curious to see how that's going to evolve.
I think that's actually a really natural lead on into our next section, which is a little bit more focused on some current events. And we touched on this a little bit, but what kind of changes would we then expect then in ESG investing as a result of the conflict in Ukraine? And the reason I think that there's kind of that link there is that sort of fossil fuel dependency and thinking about all these materials that are sort of this key issue in this conflict. And I think that, it places some pressure to transition to clean energy, but at the same time, also maybe distracts from some of the climate concerns as, humanitarian aspects of this crisis really unfold. Daniel, any thoughts there as well? And Hannah, certainly, if you have any follow-on implications too, as you're thinking about this current crisis, I think that would be really interesting.
Yeah, I think as we, think about the trade-offs between globalization and more, individually owned business channels and supply chains, we're seeing how the benefits of globalization over the last 20 years has meant that we've lowered the cost of capital. We've, all the more efficiency that we learned from all of our economics classes. But then you see when certain crises go on, all of a sudden now you've got kind of non-financial issues blurring with financial issues when there's a dependency across regions. And so number one, I think we're seeing the pros and cons of a globalized economy. Number two, as it relates to ESG, I think as you talk about, we talk a lot about the journey, the next decade, and I'm going to just hit a small tangent, but I promise I'll get back to the question that, when people say, well, what's the performance trade-off and how have your proprietary ESG ratings done and how do your ESG funds do? And I think we have to remember that these are long-term dynamics that play out over the next decade. And just like sometimes US outperforms global, active beats passive, for some reason, there's this higher standard on ESG that, hey, is it winning or not? Because then this must not be as great as you think it is. So relating that back to your question, a lot of these issues around clean energy are going to play it over the next decade. They require tremendous investment. There can be short-term pain for long-term gain. And a lot of times people are willing to ride that out in a more benign environment. But now when you have shocks to the system like we're seeing now you start to question, oh, well, wait a minute, why did we move so quickly into this? And why did we shut down fossil fuel production when we need it? So I don't have a great answer. This is a dynamic scenario, but I think I'm just highlighting some of the challenges that we're facing. And I guess if I was to summarize my answer, it just speaks to the fact that this is not a straight line solution. It's dynamic. It's going to be at times 2 steps forward, 1 step back. We know where we need to be long term, but situations like we're facing today kind of underscore some of the dynamic challenges that we have in this long-term sustainable goal for the world.
Yeah, I think you're absolutely right. There is no direct path here. These are long-term implications. It's still very unclear. One of the other things that I was thinking about that is probably going to pop up a little bit more and maybe get a little bit more attention is related to privacy and data security. So thinking about cybersecurity, I know that that's something too that has come up in the news as well, but it's, again, an ever evolving situation. So hard to say what the long-term implications are at this point. I know we only have a couple of minutes left before we get into Q&A, and I want to make sure that we also hit on and this is a hard pivot, but thinking about the ESG career opportunities for students. So I think I'll ask Jessica, could you talk a little bit about some career opportunities that you see in this space and other related sectors?
Yeah, sure. I get this question all the time. There is always somebody in my organization that has a child or a neighbor or a niece or nephew that wants to get into sustainability that, that somebody asked me to speak to. So I talk about this a lot. And the first thing I say is really, if you really want to have an impact on how a business manages ESG sustainability, you have to first understand that business. So picking a sector that or an industry that you want to learn about, that you want to be a part of, is the first thing. Kind of coming in and thinking that you're going to tell somebody how to do their job more sustainably when you don't even understand what it is, how they generate revenue, how they run their business, how things kind of have historically worked, it doesn't go over very well. And so making sure that you're taking the time to understand the context by which you want to have an impact is really important. And then I think that, and so that's kind of like, conversation I've had for many years, right? Oh, I want to get into real estate sustainability. Okay, well, first you need to learn about real estate. But I think that, as we've been saying this whole time, I think things have really changed and pivoted. And so I think this whole discussion that we've been having about disclosure and regulation is going to create a whole new class of green professionals. So emerging careers in things like carbon accounting, ESG data auditing, ESG data platforms and services. All of that is just going to, I think, explode over the next few years. And we're already seeing that starting. But if you think of like the size of the accounting sector, right, and all of the resources and jobs that are available to measure and manage financial data, if we had that equivalent on the ESG side, that would be a lot of new green jobs that become available that don't even exist today. And so that's out there on the ESG investing side. And then I think the other thing that we get left out of this conversation when we're talking about kind of ESG investing a lot is the real need that we have for technically skilled workers, especially in the real estate industry. We need to literally retrofit thousands of buildings across the country. And we need people that have the skills to go in and make those improvements, install renewable energy, make the buildings more resilient, civil and mechanical engineers to help design those systems. And so I think really making sure that we are expanding the view of, what careers are out there, and understanding that, a civil engineer might have meant one thing a long time ago, but now we're talking about climate resilience, and there's a whole nother world of jobs that are going to be available in a lot of these industries. So just, sky's the limit as far as potential.
Yeah, definitely that focus on the environment, right? Being able to translate all of these new disclosures, things that hopefully will become more standard over time. That's definitely, I think, an area where we're seeing, potential interest and growth over time. Hannah, any other interesting thoughts on your end as to different careers in this space?
I think the one thing that I would say is internships. I think sometimes you have an idea of what a job is going to be like, and then you get there and you're like, oh, I really don't like this. And so I think, doing as much as you can, trying different internships, trying, different spaces within the ESG space as well, different companies, I think is a good start. I mean, we've had 3 interns over the summer, and one said to me, my friends think this is a really dirty industry, and so I'm not really sure about it. And I said to her, well, actually, this is an industry that has to change, and this is the opportunity for you to be part of the change, be an innovator. So I think I would encourage people to look at the mining sector, because I think personally, I love to work in it because it's constantly changing, and there's so much that needs to still change. And so you can be part of the change. And I think that's a really rewarding thing. But I also think, just trying different things to find what really works for you. There's no, I think people have an idea of what ESG is, and I think we learned through this panel that we all look at it in different ways. So I think trying different things and seeing what works for you would be my advice. And I agree with everything that Jessica said as well. So.
And I'd be curious, Daniel, as we move to the last question here, and I promise we will get to Q&A, but what are some resources that students can use to learn more about ESG?
Sure, I think, going out to some of the industry leaders, like whether it's the PRI, the UN PRI, the UN SDGs, a lot of asset manager websites have written white papers like we have at Fidelity that are available to the public. I recently went through the CFA Esg Certificate in December. That's not the 3-year commitment like the traditional CFA is. So I think that was a great opportunity to, study for, 6 or 7 weeks, obviously around your own schoolwork, and I had to do it around my job. But there was just a tremendous amount of information to learn, as they've done a nice job of defining. It's a nice little carrot that you can carry along with you on your resume. And I always find folks that take them, when I used to interview folks that had their CFA, just pivoting to the career for a second, I used to say, it's not only what you learned in the CFA that impresses me, but it's that you sat through a structured study program that was driven by your own focus, took 3 years to accomplish something, taking an exam that used to be once a year with all that pressure. And that's what impressed me about folks. And so I think the more times in your career that as we pivot between the resources and the learning, that you can show that you worked hard towards some of these certificates. It's not just what you learn, but it's showing that desire to just go one step further than everyone else and take the stress of applying, getting it. If I had $1 for every person in my, I don't want to say just my firm, but in the industry said, I've seen that CFA certificate, that looks great. Well, I took the 6-7 weeks to grind it out around, a pretty solid job, just like you would have with your academic work. But anyways, I want to make sure I answer the direct question. So I think there's a lot on the internet, Googling things, lots of white papers going on. And I'll just end with, there's such a demand for the taxonomy and the terminology that one, there's a lot being published on it, because we're not in an industry that's 10, 20 years old, large cap value, very clearly mature industry. But two, that can give you an edge, because what someone knew 10 years ago is irrelevant today almost. So if you're current in your learning, you're going to be equally competitive as almost anyone else that's been focused on sustainability the last 2 or 3 years.
Yeah, I think the only thing that I'll add just from our conversation about materiality is I recently saw Wharton release a Coursera called The Materiality of ESG Factors. It looks like it's free and open to anybody, and really designed to help you figure out how to integrate ESG factors into business decision-making, thinking about the fundamentals and history of ESG. Sounds like it could be a nice parallel and maybe a complement to that CFA certificate as well. So just another potential resource out there that you could look for and Google. So it looks like we do have one question coming in here. So this is probably going to be, I'm probably going to direct this to you, Daniel, so heads up here. But the question is, so companies that rank high on ESG have performed well over the past few years. ESG may gain more traction over the long term. However, some of the students of this individual are wondering that, has there been too much focus placed on the investing world on ESG and hence valuations? They are wondering if some mean reversion will happen in terms of valuations for companies based on ESG, at least in the short to intermediate term. Any thoughts there?
That's a very thoughtful question, and I would say applies to the real world. So that's why I love the question. So you're absolutely right. And one thing we try to reinforce, both reminding our investors at Fidelity and our clients, that the sustainable evaluation is just one of many inputs. And so we still need to look at valuation. We still need to look at market technicals. We still need to look at the size of the opportunity set driven by that quote unquote ESG leader. So to your exact point, there are times when we're going to see, just like growth or value or US versus non-US can ride a certain momentum wave and possibly be a little overvalued over the short term, that we need to be very sensitive to that. I grew up on the bond division at Fidelity, and we see that a lot with green bonds. It's called the greenium, where for equal risk in the company, you're not getting any more seniority by issuing a green bond. But because of all the demand for sustainability, all the mutual funds that have been labeled ESG and therefore need to buy these bonds, they trade at sometimes yields lower than traditional debt. And that's a valuation metric. It's not a safety metric. And so very smart question to say that you're right. These will ebb and flow. There can be overvaluations, whether it's reality or just riding the ESG wave. And I think our job as investors is to say, when has that been priced to perfection, and or how do we think that plays out over the next decade, even if we're getting in a little rich today?
Yeah,
Yeah.
I can jump in on that if it's okay.
Yeah, absolutely.
We've been talking a lot about green premium, brown discount within real estate, and something that Daniel said earlier, and then again just now, it made me really think about. One of the challenges is we try and take this data that we now have access to for the first time around ESG, and then look historically at the returns. And that information was not used to value those buildings or those companies at that time. And so it's almost like a mismatch, right? We want to look back into a time when ESG wasn't considered and try and make a linkage between valuation and the greenness of the building, but that wasn't actually part of the consideration. So it just doesn't make sense. I think you are going to see a big shift as we move forward. All of this data is now going to be readily available, and it will be part of the investment decision and the valuation. And I think then that you are going to see this shift to all of a sudden a building that looked shiny and nice and was getting really great rents and seemed to be in the perfect location. And all of a sudden you find out that it's really poor energy performer and it's going to be hit with fines because of not meeting local performance standards. That's all of a sudden going to now come into play where before it just wasn't part of the conversation.
Yeah, I agree, Jessica.
Well, I know we're almost out of time here. So I think, I'm just going to try to sum it up as some of the themes we heard today. So we heard a lot about disclosure. We heard a lot about transparency, standards, thinking about ESG materiality, the fact that ESG spans across multiple industries, and really, if you're thinking about combating greenwashing, really getting into, the core of the company, not just your, I loved the sustainability SWAT team. So I think, any other final thoughts before we close it off and turn it over to our student leader? Okay, well, I would thank everybody on this panel for participating, and thank you for tuning in. And I will turn it back over to, I think, Ricky.
Hi, everyone, same thing. Just thank you for your time today. It was excellent insight from our panelists and moderator. That was an exciting chat. That concludes our second session today. Thank you, everyone.